assume I got some feedback from one of you that you can hear me okay. I'm going to keep this on presentation mode just because it gets a little bit, I don't know, I've adjusted these slides for this presentation a couple times to make them a little clearer so what I'm trying to convey today. We're just going to go through some pricing issues, how to price it more affordably. And so if you do have a question on one of the slides, feel free to chime in. There's probably other people asking the same question. That's the beauty of having a live webinar, is the ability to do that. Now, if I hear some background noise, I'll go ahead and switch to presentation mode. So just try to mute your phones or whatever, and just try to spend 15, 20 minutes with me here. We'll try to help you design more affordable plans. To start with, my name is Jeff Clark. I'm a regional director here with GoldenCare USA. I've been with the company for 20 years. I spent my first 5 or 6 years in the field selling long-term care door to door. A lot has changed since then. I became a director again 16 years ago, and my job now is to recruit and train agents. But I still do quite a bit of selling on the side. You know, I've written about 650 policies, and so over the time, as I've been a director, working with the carriers and helping agents design plans, quote plans, group, association, you know, you learn a lot about the industry, but I do like to still sell because it makes you sharp. Now, recently I've been doing some selling. We've had some web-based leads, and a lot of it's internet selling now, and so I just was sampling out some leads, and I ended up doing some selling a couple months ago, and I came across a couple things as my 2 cents for selling what kind of helped me with some of these price issues. What I hear from a lot of agents all over the country is it's too expensive. The premiums are too high. You know, that the clients look at long-term care and they can't afford it. And I always ask them, what are you quoting? Are you starting with a low plan, or you? And so, we can't just look at the price of long-term care and quote what the local costs are and think that people are going to buy it. As everyone knows, the price of long-term care has gone up and up. The actuaries, the companies just didn't have it priced right 10 years ago, 15 years ago. Policies are 2 to 3 times what they used to cost. And with the safe assumptions that these actuaries are using to price the policies, using very low interest rate environment in this country, it's just gotten very expensive. And so we have to be very creative in how we design these plans. So that's kind of the premise of this. Just my own, after going into the field again, a couple things I noticed, the higher prices, and also the competition with the hybrid long-term care plans, the life and long-term care. So those are 2 things I want to talk about. So without that, I'm going to go ahead and move on here then. And so we have, just moving now. All right. So I talk about long, skinny versus short and fat. This is a slide, a premise that I think we all kind of know about if you've been in the industry for a while. I was just reading something in the Association of Long-Term Care, about the bulk of your care is going to happen, in the short term, 1 to 2 years. Your chances of needing care beyond 2 or 3 years in a nursing home, for example, or long-term care services, you're starting to talk about less than 5% of people are going to go beyond 3, 4 years of care. And so I've always been a big believer in shortening the benefit up, giving them as much benefit as possible in the short run, because that's where 90% of the care is going to happen in the first 2 years. And so for years, I always saw people quoting what I call the long, skinny plan. This is a very typical quote here on your left. This is before they really started pricing the 5% compound inflation differently, but they'd write $150 a day on a 5-year benefit. They always say, well, my Aunt Ethel was in a nursing home for 7 years. We got to make sure we get at least 5 years. And a lot of agents did this. A lot of people quote it this way. So we have $150 a day, or a $4,500 a month benefit. We have a 5-year benefit period. So essentially, you take 45 times 5 years. You end up with a $270,000 pot of money, 100% assisted living, 5% compound inflation. This is for a married couple that's age 60, okay? And I use Missouri for this example. Now notice here that, so right now their benefit's been paying $4,500. In 10 years, that same benefit's going to grow at 5% to pay $73.28. In 20 years, we'll be paying almost $12,000. And in 30 years, well, actually the average claims happen around 82 years old. So they can expect somewhere around 20 years is when it's going to kick in. And so it's almost $12,000 at 20 years, and when it gets to 30 years, you're at 19. Now again, I'm going to go to the software to kind of show this. This is my example on the right. So I'm going to put the software up. So this is what you quote people, and I like to use the software when I'm selling. Sometimes it just kind of helps me. I wonder if I can blow this up a little bigger. I hope I can make this a little bigger, but that's okay. So essentially, I like to use the software when I'm selling people just because it has everything on the screen. The Mutual Omaha software is just so easy to work with. Everything's point and click and recalculates immediately to blow you. And so if I were sitting with a couple, again, I would take the same quote design. See if that helps right there. No, not really. I'd take the same quote design, and I would go ahead and I would change. I'd still keep the $270,000, but I'm going to go to a $250 a day or $7,500 a month benefit instead. Then I'm going to go to the inflation. I'm going to move that down to 3%. Okay, and I'm going to take the assisted living. I'm going to put that down to 50%. Okay. And so all I've done here is they still have a pot of money of $270,000. But now they have a monthly benefit of $7,500. You know, it's a 3-year plan now instead of a 5-year plan. It's still the same pot of money. I always tell agents, try to coach people, don't get hung up on the pot of money. Don't get hung up on the years. Excuse me. The years are arbitrary. You don't know if someone's going to start at home, receiving 80% of claims start at home. And they're getting maybe home care once or twice a week, or maybe they're taking the cash option. A benefit pool is going to last a lot longer. And $270,000 pot of money, as you know, the cash benefit, the 40% cash benefit, it lasts you 9.38 years or 2.81 with straight reimbursement. If you go straight to the nursing home, that's it. Okay? So, that's a $270,000 pot of money is a very large pool of money. Don't get hung up on the years. So all I've done with this person is I've increased the monthly benefit. Remember, the likelihood of using this care, 90% of the stuff happens in the short run, the first 2 years. And at $4,500, we all know that that's not going to cover a nursing home anymore. So that client's going to have out-of-pocket expenses, and so they have a long, skinny benefit, so they're going to be out-of-pocket for over 5 years. And people, in my opinion, want to get their money back out of the insurance plan that you sold, so you want to really stack this thing in the short run so they get a lot of benefit and less out-of-pocket. The unused amounts stay in the account, and so there's no reason not to do a short and fat policy. They're just going to extract those premium dollars out of there. You still get $270,000 either way. I took the assisted living down from $7,500 to 50% of that, and so that's $3,750. We were at $5,000. 3% inflation. Now, 3% of $250 is a $2.50 raise. Well, 5% of $150 is the same, $7.50 raise. And so I've really taken nothing from this customer, but I've dropped their premium from 93, back to PowerPoint, down to 58. Look at that premium difference. The premium, the policy on the right, it's the same $270,000 pot of money, but it has so much more benefit for the client. Now, the 5% versus 3%, yes. 30 years down the road, you're going to see a crossover in this, okay? And I always look at the quotes, and I look at the crossover points, and, the future values, and so the average claims have 82, so at 12,000, 13,000, somewhere around there, it is going to be surpassed around 30 years. But this puts those people at age 90. And if you're worried about the future, then go ahead and put this a little higher. Move it to 8,000 instead. You're still going to come way under premium. Now, having said this is just a concept to use. I don't use numbers like this anymore. I don't do $270,000 pots of money. We used to quote this 10 years ago when I first came up with this concept of this slide. But I rarely quote this big a plan anymore. So, price-sensitive clients. When I'm quoting folks these days, if you go ahead and if you're working out in the East Coast, for example, maybe you're working in Connecticut or Massachusetts, and the local care out there cost for a nursing home can be upwards of $10,000 a month. You want to be sure you get at least a 5-6 year benefit. You got to put some inflation in there. You're working with a 60-year-old and you get 55 and 60. Well, if you start out with a quote like that, so again, let's go to Connecticut here. Okay, let's go to let's just do a benefit there at $10,000 a month because they give me as much as 12. Let's do a pot of money. Well, we got at least a 3-year plan, right? So at least 3 years. I'll do 350 here, 375. Okay. And so then we're going to put 3% inflation there. Keep the assisted living up there. For a 60-year-old couple, this is an awful lot, even using 3%. A $10,000 a year premium is just something that they'll never look at long-term care again. They might just think, this is just too expensive. I'm going to save that money and invest that $10,000 a year. So we really have to be careful with how we're quoting. My suggestion, and go back to the slide with the other, I like to let them know it's affordable. So I start with a $3,000 a month benefit and a $75,000. That's what I've been starting with in all my quotes. quotes. I've had some very good success with this lately. I end up selling up from there. But so I'm going to go ahead and sit. I'm going to start with a 3,000. Connecticut's probably a tough place to do this. You got to start with at least 5,000 there. But let's go back to Missouri here. So I'm talking to some in the Midwest. I might start out with 3,000. I might start with 75,000, and I'm not even putting any inflation in there. I'm just going to take it out of the equation for right now. I know it's not partnership, but that's okay. All right. Now I can go to this couple, and this 6-year-old couple, and say, monthly here, we're talking about, between the two of you, we're talking about $39 for her, or for him, and $56 for her. What this is telling them, now this isn't the plan I'm going to sell them, but if I'm going to email a quote out, if I'm going to send something to anybody, I'm not going to send them a $10,000 annual premium at any point. I'm going to send them a couple lowball ones. Here's a $96 one, and then maybe on this one, maybe I'll put 1% inflation there. So do lifetime here, and maybe we'll do it with 1%, or maybe even 2%. All right. So again, now we're talking $62.91 for her, so it's $150 total. Knowing that with Mutual of Omaha, you can increase this 2% to 3 or 2.5, 3.5, 4. Anytime over the next 20 years, they can increase that free of underwriting. And so the next one I might send these people, I might send them a couple quotes, 3,000, 100,000, and then a 4,000 and 100,000. Again, first with no inflation. Right, I'll just take it off there. What I'm doing here again, just showing them it's affordable. Now, more often than not, I kind of back into it and say, I think 100,000. They'll tell you that they think 75,000 isn't long enough for 2 years. And, we really should probably get at least a 3-year plan. Well, they're not going to argue with them. I'll go ahead and put 150,000 on there. And with inflation, then I'll tell them, we can start this with 1% maybe. Maybe it started at that, and then we'll work our way up from there. So, what you're comfortable with. Or maybe we'll go ahead and back this down to 125 and put inflation there. But again, starting with these low levels here, you're going to be able to get them to at least book and start shopping. If you quote that big level comp, I promise you that you're just going to turn them off. So if you're quoting or sending information out, start with a 3,000 or a 4,000 per month benefit and a $75,000 pool, or a 4,000 a month monthly benefit with 100,000 maximum. And then work your way into the 1 or 2% inflation. I know that at least 3% qualifies for partnership. Not a big fan necessarily of partnership, but I don't think it comes into play very often. But if that's what they're asking about, then you want to go ahead and go to 3%, maybe lower it back a little bit. But keep those premiums down. You really want to keep them, under $150 or $200 for both of them to start. A lot of times, the clients that have the money that want to buy, they're going to suggest you can step up from there. I always then send them maybe a couple higher quotes later they can look at. Okay, so here's the other thing I noticed out in the field a lot of is you're seeing a lot of these hybrid plans. Everywhere. It seems like right now. I just read somewhere in 2014 there was 3 long-term care policies sold for every 1 life and long-term care hybrid plan. And now, come full circle here, now you've got almost 4 life and long-term care hybrids written for every 1 long-term care plan. Now, there's a lot of reasons for this. People saw the rate increases in history the industry had, and they liked the idea of not having to pay everything in, and once they died in their sleep, they lost all their premiums. And so I understood that. There's always been a return of premium rider in a long-term care policy, but if you ever price those, they're not very advantageous for the client. They charge an awful lot of money. You're always better off just to go ahead and buy a life insurance policy instead of the return of premium rider. And so we've always kind of done it in the industry. But with these hybrids now, people have just abandoned the long-term care thought for going to the hybrid. For the people who say, what if I die in my sleep? Or what about rate increases? To start out with rate increases, we all know that the industry has learned their lesson on pricing. They're using very, very conservative low-interest rate models to price it. They've got tens of billions of dollars of claims paid out. There are numerous articles out there that say that the chances of needing rate increases on these newer priced policies are between 5 and 10% likelihood, according to actuaries, etc. A study of 80 actuaries recently just had it out. I was on the Association for Long-Term Care's website. I just read the article today. I've got other ones like it, but we're just not going to see the need for these big rate increases. But if they still are concerned about it, and they're worried about the use or lose it, and they want to buy the hybrid, I still don't understand why people are doing it. So what I've done here is I've priced a couple hybrids, hybrid A and hybrid B. Just some of the companies out there, the usual suspects. You guys probably know who they are. And so I'm just wondering why people are putting so much premium down to have this. It's a death benefit. This example of $125,000, a $5,000 a month benefit. I'm using a married couple of 55 and 50. So hybrid company A, again, this is just universal life with the chronic illness rider, the long-term care rider. So if they die, they get a death benefit of 125. If they need nursing home care, they get $5,000 a month until the 125,000 is gone. That premium plan is $5,000 for hybrid A, $4,200. So what I did here is I went ahead and I ran a long-term care plan with a $5,000 a month benefit and a $125,000 pot of money. And I didn't put any inflation with this because the ones on top here, these rates here, they don't have inflation with the hybrids, okay? They're just flat rates. And then what I did is, here's the premium, the LTC premium for this couple at $125 and $5,000 with no inflation. The LTC premium was $1,300. I went out to a couple carriers and I priced a second-to-die life insurance policy. So if people are worried about losing their money and putting the money into it and not getting their money back, I just gave them a simple second-to-die that's equal to $125,000, and that premium is $1,166. So their total now is $2,496. So they are getting, not only are they getting the death benefit, but they're also getting long-term care benefit. They're not getting either or. In other words, if you use the death benefit, you don't get the long-term care benefit. If you use the long-term care benefit, you don't get the death benefit. So instead of having an or situation, you get both benefits here. You get all your money back, and it's half the price of a hybrid. So I'm just really having a hard time. The hybrids have got a place in our market. There's people it just makes sense. Maybe you've got qualified money sitting in an investment of some kind, and you buy one of the annuities, or you've already got a life policy. Or I'm not trying to say that they're a bad thing. They're being overdone at this point. Everyone's kind of looking at the hybrids, and I'm just for the life of me trying to figure out why. So here's the other one I put down here. With this example here, I used 3% inflation with that $5,000 a month benefit and $125,000 on the long-term care portion. That put the long-term care premium to $2,866, and the life premium, of course, was still to $1,166. They're going to get refunded this $125,000, and so that premium they're going to pay is $4,000 a year. Even if these folks pay this for 30 years at age 60, there's your $120,000 you paid in. You're getting all that back. Okay. So how does this shake out? So again, the premium-wise, take a look at the benefits here. Actually, I did two of them, then we'll look at benefits. This one I did use inflation. So this one I went ahead and put the inflation in there for the hybrid A and hybrid B. And on this one, I also did the inflation. So I did flat rate here, and then I did the 3% compound inflation rider. So that, of course, is going to be $1,865 and $3,937. Okay, so how does it shake out? So hybrid A. Remember, we had a premium of $5,000. Hybrid B, we had a premium of $4,219. This gets you a $5,000 a month benefit, or it gets a death or a long-term care benefit of $125,000. So with hybrid A, you're getting death or LTC. The long-term care scenario that compared to this one, hybrid A versus up here versus right here, $5,000 a month benefit, $125,000 benefit, and a guaranteed $125,000 death benefit with the second to die. So you get the same exact benefit for long-term care, and you get a death benefit. In addition to, and it's half the price of a hybrid. Why on earth would you sell a hybrid? I just don't understand. Okay, hybrid B here, this is the one with the inflation in it then. Or excuse me, this is not the one with inflation. This is the rate with inflation below here, this 4,302. This one now does have the inflation in it. So comparing it to, I have to compare it to the premium right here that has the inflation with it, 76. But so if you're comparing this to the one without inflation, you're still $1,000 under this rate. It's $12,000 per month benefit. And by the time they hit claims, some 30 years later, it's a payout of $12,000 per month, and a death benefit of $303 is what it's grown to. Excuse me, the long-term care benefit is $303,000. Your death benefit, of course, is staying at $125,000. So look at these two premiums. This is hybrid A. They sold this without inflation. This is my solution to going against hybrid A down here. So I'm going to do a second to die life with a long-term care benefit, starting them both at $5,000 and $125,000. That gives them a monthly benefit when they come claim time of $12,000 versus the hybrid's $5,000. It gives them a pot of money for long-term care of $303 versus the hybrid's $125, and they're still going to get a guaranteed death benefit of $125,000. So again, it's really not even a close situation here. I do applications. It's hard to get my agents to buy into it because they actually have to take 2 separate applications. But if you want to really be a specialist at this and take some time with your clients, show them this because they're just spending unnecessary money on that. And so it's a nice way to save them some money. So this next example here, again, this is showing the hybrids with inflation. Okay? So this one actually, I took those premiums and I put the 3% inflation with them. So they even still, the second to die life here, if you look at the premiums here, these are still going to be underneath these premiums here. So we got 5,800 versus 76 or 82. Now they're both growing in inflation. Difference now, of course, is, no, this is an older couple. This is a 65-year-old and 60-year-old. So now hybrid A was 7,600 and hybrid B was 8,224. Okay? So the premium is still, at this age bracket, it's still under both of these things with inflation. But now in 20 years, I've got, these don't have inflation within the 76 and 8224. So the 58 with the inflation is a 9,000 benefit, 225, that's how much it's grown in 20 years. So even if you're talking about 65 and 60-year-olds, 55 and 50-year-olds, it's just a much better deal to buy a pure long-term care plan and couple it with a second-to-die hybrid plan. Boy, this has not been very clear. I apologize. I'm hoping to make my point here. Again, it's just a little tougher to maybe make them see this. You have to present them 2 different products. But instead of them spending $7,600 or $8,200, they can spend $5,800 and have a monthly benefit come claim time of $9,000 versus $5,000. A total benefit draw from for long-term care of $225 versus $125. And it's not an either or. They still get their guaranteed death regardless if they use the long-term care portion of it. And so you're getting the LTC and the guaranteed death benefit. I hope this kind of, if you guys can make sense of this time, again, I think I'll have to just try this thing again and lay this out in a way that makes sense for folks. But going back to the original premiums here, here's hybrid A. Hybrid B is a 55-year-old couple, 55 and 50, 5,000 premium and 4,000. They run the same things with long-term care, one without inflation, one with. Both are under the premiums for both these hybrids, and the benefits come out a lot better. So then, of course, we did the one with the 65 and 60-year-old, same scenario. I don't care what age bracket you're working with. If you went ahead and put inflation with these hybrids, these rates go to over 10,000. You're going to be basically, and let me wrap it up in a nutshell here. I'll turn over to questions because, again, it didn't quite go as smooth as I'd like. If you're out there going against a hybrid, give a call here to the office. Ask for myself, ask for another one of the directors. What we can put together for you is you can present that client who's looking at a hybrid, you can present them something that's half the premium that gets them a death and long-term care premium or benefit. And also, by the way, the savings, you get tax deductions in your long-term care insurance premiums as well. And so the savings just add up. You guarantee them, instead of giving them a death benefit or a long-term care benefit, you give them both. You give them a long-term care benefit and a death benefit, and it's half the price. So if you go against hybrids, and again, there's nothing wrong with hybrids. They're very popular in the industry. People are selling a lot of them. I think it's because of the ease of them, because the consumers are fearing the rate increases, fearing the user will lose it. Take that fear away from them. Just tell them, if you pick however old they are, estimate the premiums they're going to be paying for 20 years, sell them a $100,000 second-to-die policy, or even a first-to-die. Either way, you're still coming in way under, and you're cutting the premiums in half. And so that's kind of the gist of what I had today for pricing, so you're not scaring your clients away. Keep the prices low to begin with. Don't hit them with a big premium. Hit them with a $3,000 a month benefit, a $75,000 pot of money, or a $4,000 and a $100,000 pot of money. Those are usually the first 2 looks I give them. And then when we get together, we kind of play around the software and move things up from there. And also, if you look at these hybrids, people aren't excited about spending $5,000, $6,000, $7,000 a year on a hybrid. You don't need to do this. You can actually sell a quality. And the long-term care benefits, by the way, within the policy of the long-term care benefit, is going to be a lot better than the benefits within a hybrid life and long-term care benefit for long-term care, because they don't have the things like the cash benefit option. So you're not going to be able to pay your family members, your daughter who's helping out. Like I mentioned, I've sold over 600 policies. I get claims once a month. They always want to know if they can pay their daughter or their spouse, their neighbor kid who's mowing the lawn. Hey, with these hybrids, it's a reimbursement contract. Most of them are. And so the long-term care benefit's not as good. It's twice as expensive, and it's an either-or deal. Save your clients a lot of premium, quote a long-term care plan, pure long-term care, with a second to die or a life policy of some kind. Call the office. We'll show you how to do this. I hope this helped at all. I'm going to open up the questions. If you guys follow that, I can bring those slides up too, or send you copies of this so you can kind of see it. Well, again, for anyone other questions or comments, again, I hope I'm not upsetting the hybrid people that are committed to the hybrid these days. There's nothing wrong with them. I mean, some people are asking for them. They've become very popular. I guess for me on selling them, I'm just wondering why people are doing them. I just think you can save your clients a ton of money and give them a lot more benefit, for half the price. I know it's taking 2 applications, but if I'm an agent and I'm walking in behind another agent who just dropped a big expensive hybrid down there, I'm going to replace that sucker. I mean, it's not going to be hard to do. So, anyways, just some food for thought: how to keep prices down, how to try to keep people insured. Some coverage is better than nothing. That's why we believe in a little lower pricing models to start. Add them up from there. I want to thank you guys for coming on board. There's numbers on your screen here: 800-842-7799. Please give us a call if you have any questions, or if you want the next case you're going up against, or maybe you have a hybrid, or maybe you just want to quote a case, you want to kick some ideas around, give us a call at the marketing office. We'll help you quote it. We'll help you design it. We'll give you everything you need to help you make that sale. But I want to thank you for joining us this morning. GoldenCare USA. Again, Jeff Clark here signing out. Give us a call. 800-842-7799 is the number. And thanks for coming on board this morning, folks.